I can share this screen share किया तो board को आई जाएगा.
हाँ हाँ आ गया ना, वापस तू बोर्ड पे आ गया. Now you can teach on the board as is. जो अपना बोर्ड वाला काम है वो सेम है. There is no change. Right now the recording has been turned on.
Okay.
So everything is being recorded. So DVD is ideally.
to target recording में इसमें वाले के नीचे वाला.
नहीं बंद कर दिया ना ये नीचे वाला. हाँ बट दोस्त हाँ वो कैमरा ऑन कर दिया तो कैमरा चालू अभी करंटली क्लास का. Divija is ideally expected to join.
Okay.
I think Divija is joined.
Most people.
हाँ इधर से बैक चले जाएगा तो आइडेंटिटी तक क्रॉस है ये.
Whenever I share to the हर बार पेज चेंज करता हूँ, हर बार zoom in करना पड़ेगा.
तो वो आई थिंक हम लोग को एक आधा बार है ना, वंस वी स्टार्ट ये क्या बोलते हैं प्रॉपर टीचिंग ना, हमें फिर वो एक बार वापस ट्रेनिंग करवा लेंगे. दिविजा कैन यू हियर अस? दिविजा कैन यू हियर अस?
Yes, she was.
Yes, sir.
थैंक यू परफेक्ट. ठीक है. I'll just mute you, not changing any other thing. Just in case if the class is muted at some point, so just unmute yourself and mention it. Okay.
Okay, sir.
Okay. So maybe before we start for what we were, and we'll continue what we were doing the last time, right? We just quickly recap what we did last time, right? We spoke about the actuarial control cycle. So all the people who were there in the last time, I hope you all remember and recall at least something about what the actuarial control cycle was. Okay. So anyone, what was the actuarial control cycle about? What were the key steps? Problem identifying the problem, solution, and monitoring, right? And उसके ऊपर there were two overlays, which is your external environment and professionalism. Okay. So yeah, that was basically the gist of what we did last time. Today, what we will do is we will complete the remaining portion. We also spoke about risk actually, what risk is, what are the typical risks which a bank faces, which an insurance company faces, right? What is the materiality of those? For example, for banks, credit risk is the most important. For insurance, not really, right? Credit risk is highly limited. But for an insurance company, you will have a very high insurance risk, which is mortality, morbidity, surrender, etc., which does not exist for banks, right? So, what are the common risks? And those were the points we spoke about, right? Today, what we do is we just complete that portion on what the risks are, what to typically do to manage and measure them. Then we will move on to actuarial advice, what exactly that is, how an actuary advises, what are the mandates, so on and so forth. Okay. Now, let me just share the screen. Fairly visible to the people at the back, right? Okay. Okay. Yeah, so this is where we had stopped the last time, which is what are the kind of risks which are there? Why is it important? The risk is basically where you have an element of uncertainty. Okay. So continuing forward, right? The common risks faced by banks and insurance companies we spoke about. What are the risks faced by hedge funds? Does anyone know what a hedge fund is? What do hedge funds do?
They set ourselves so that
Sorry,
they invest in stocks or whatever security so that they'll be able to manage that
Correct.
process.
see, not hedge. See, even though the name is hedge funds, they don't hedge. They speculate. Okay. Hedging is basically where you reduce your risk. Hedge funds deliberately take on risk and take on positions. Right? They will do everything from equity, debt, derivatives, any and all assets, property, paintings, everything. Right? So hedge funds are basically they exist in order to make as much money as possible. You have very big hedge funds in the world. You might have heard of those. One is the most famous one. I don't know if you would have studied about it, is the Millennium Hedge Fund, which is or was run by one of the most famous people who was alive till about a few years back, right? So all these hedge funds basically invest in these assets. They speculate in order to make money. Okay. Now, what are the risks which a hedge fund would face? Market crash. Basically, market risk is the biggest risk for them, right? They took a position in, let's say, oil, saying that oil prices will fall. But yesterday, based on the news, oil prices went up. Now, that's a huge risk and a loss which they face, right? So, market risk is the single biggest risk for hedge funds, where market movements and market volatility can wipe them out, right? Other risks which exist, operational risk exists in every organization, right? Your trader had to punch in an order for 10,000 stocks. but punched in 100,000. So you were forced to take an outsized position because of an operational error, right? Which other risks are there? Whoever is thinking. Okay, so the thing about hedge funds is they operate because they have less regulation. Otherwise, it sort of becomes like a mutual fund, right? Mutual fund is heavily regulated. They can't really do a lot of, they can't do derivatives, they can't do many other things, right? But a hedge fund operates because regulation is less. So yes, the risk remains that the government decides that, let's bring the hedge funds also under the fold of the regulation. But that is still a lower risk. Otherwise, because think of it this way, right? Hedge funds provide a lot of liquidity to the market because they take the positions which others may not be willing to take. So you don't want to wipe that out. Other risks which could remain are reputational risk is a big one, right? Because if you've invested in reputational risk can come about in, let's say if we take 2-3 examples, right? Let's say you have financed the setting up of, let's say I'm a US based hedge fund. I have financed or invested in the setting up of an oil refinery in Africa, right? Where news emerges that let's say child labor is being employed or people are being exploited there. Now that can be a reputational event for me, right? Because it is possible if my investors are against that, they will pull out their money, which can again cause a lot of problems for me, right? So some of these risks are the ones which they face. Credit risk, yes, because they also lend money. If that person or company goes into default, then you lose your money. A very big risk is liquidity. I can give you just as a very small example of case study. Have you ever heard of long-term capital management, LTCM? So LTCM was a hedge fund set up by Black-Scholes model, सुना? So Black-Scholes model जिससे बनाया था, right? I think Myron Scholes and Robert Black, those were the guys who set up that hedge fund, or they were directors on that hedge fund, right? Around 1995, something like that. Now that hedge fund was established basically to make money out of pure quantitative trading strategies. Okay, whatever data says, no human element, no subjective calls. Okay, it did really well in the first 2-3 years, returned gain like 30% in a year, right? Which is great return. But what so ended up happening? This fund went bust after 3-4 years. They had to basically salvage. The US government had to salvage the situation by getting the big banks to buy into the fund. Okay, why did that happen? The reason was liquidity problems. Okay, what do I mean by that? They had basically taken positions based on data, right? Now, without getting into the details of it, what they used to see, hedge funds operate at a leverage. Leverage का मतलब, if you all know how the F&O markets operate, futures and options markets, let's say NSC or BSC, right? How it operates is, अगर मुझे Reliance का share खरीदना है, I have to pay 2,000 rupees cash. But if I want to take a position in Reliance share movements, I am able to take it at, let's say, 100 rupees. So with 2,000 rupees, I can take exposure to 20 shares rather than one. So I'm operating at a leverage of 20 to 1. Now that's the principle at which hedge funds operate, right? Because if you don't have leverage, you cannot make outsized returns. And if you're not making outsized returns, why will someone invest in it, right? So these guys are taking positions in the market, right? At that point, some geopolitical volatility happened. There were some issues with Russian bonds, which basically went into default. Okay, when Russian bonds went into default, people started withdrawing their money from emerging markets. Basically, लोगों ने इंडिया से पैसा निकाला, रशिया से निकाला, एशिया से निकाला, अफ्रीका से निकाला, and they put it back into US. Because as always, US is the safe haven, dollar is the safe haven. So any geopolitical shock, people start withdrawing money. Take the Indian markets, for example, in the last 6 months, FIIs have withdrawn a record amount of money from India, right? So when you withdraw money, their position in Russian bonds basically ended up resulting in margin calls. Okay, margin calls basically means कि MTM कम हो रहा है, they are facing losses on their position, so they need to put up more money. That amount of money was in billions of dollars. Okay. Now, after 6 months, situation normalized, and their call on the strategy was right. That जो strategy design किया था कि we will make money out of it. Yes, that strategy was proven right. But what their model didn't factor is if a geopolitical event or a shock of that nature happened, वो 1 month में पैसा कहाँ से लाएंगे? So in that 1 month period, right, they were not able to put up the money for margin. So naturally they had to liquidate the fund. So here, as I mean, this is why liquidity is a very important factor for, I mean, pretty much all companies, right? And this is a live case of how billions of dollars worth of hedge fund had to go into default and had to liquidate itself. Because even though your strategies were right, you didn't have the money to front the strategies. Right? So liquidity is also one of the most important factors which can make or break a fund out here. Okay. So I think, have you all studied about ALM, asset liability management? Matching the cash flows of assets, duration matching, convexity, and those factors, right? So ALM basically tries to ensure that your outflows and inflows in various time buckets, right? Let's say less than 7 days, 7 days to 15 days. Whatever, I mean, more than 15 days, right? You are able to match the amounts, okay, to the extent possible. Because if I have to pay, let's say, 100 crores in 10 days, right? I need to ensure I have 100 crores in 10 days. If I don't, how will I meet my liability, right? So asset liability management, again, this is a very simplistic view of it. It's obviously much more complex because your products are not so simple. So asset liability management is where you are trying to match both the duration, the cash amounts, as well as the valuation. Valuation matters a lot because for pension fund specifically, right, where you do the valuation of your pension liabilities, right? Valuation of the assets needs to be above a certain level, or else you will be asked to put in more money in the fund, right? So valuation also is quite important out here. I'm not getting into too much details of this. We will study about it as we go ahead, right? But risk obviously is a measure of two factors: magnitude and likelihood. Okay. And so, what is the chance of the risk happening if I were to plot a chart, right? Let's say this is the likelihood and this is the impact, right? Something which lies here is very high risk. Okay, why? Because the chances of this event happening are very high, and if this event happens, the loss I will face is also very high, right? The risks which lie here, I may not be too bothered by them. Because तो chance भी कम है और अगर हुआ तो भी loss is manageable, right? So these are the sort of events which can bring about ruin, right? High likelihood and high impact. You also have a lot which will lie around here, let's say low likelihood but high impact. For example, a pandemic has a low likelihood but a very high impact, right? So these are the sort of events which I will then see. Why are you plotting all of this? When you create, in reality, when you go and create a risk register, right? Which is where you're identifying what are the different kind of risks, what are the different events which will impact my risk, right? You end up creating a likelihood and an impact matrix. Why do you do that? So that you know which risk is more material and which risk is not so material. The ones which are not so material, you're like, okay, I will accept it. Okay? Because for risk, what can I do? I can either accept it, I can reject it, I can transfer it, maybe I can mitigate it. I will accept the risk which is low likelihood, low impact. Why? Because chances become अगर हुआ तो भी my losses are very limited, right? So I can absorb it because that's within my appetite, right? Some risk I will have to reject. For example, something which is very high likelihood and very high impact, right? If the chances of happening are very high and the impact I face, the loss I face is also very high, do I need to accept this risk? I would ideally want to change my business or my product features to ensure that such events don't happen. Because the issue with this is, if it's a high impact and high likelihood risk, right? इसको आप transfer भी easily नहीं कर पाओगे. For example, if I want to move this risk to someone, right? They will charge me a very high amount. Now that also is a problem. So that is why such risks which lie on this side of the spectrum are typically rejected. Right? That leaves transfer mitigate. Mitigate होगा, for example, derivative ले लिया. If you have interest rate risk, you do an interest rate swap. If you have a foreign exchange risk, you do an FX swap on an FX forward, right? So you are mitigating the risk there. Transfer means reinsurer को pass on कर दिया. You are sharing the risk with them. So these factors, or let's say the ones which lie in the middle, will fall somewhere here. Mitigation is not just this. Mitigation can also be you establish proper SOPs, proper system checks, etc. Standard. So SOPs are process documents, right? कि किसी को, for example, if someone is selling a policy, so all companies have SOPs, okay, for all the processes in their departments. So sales team होगा, उसका एक SOP होगा. How do you approach the customer? Once you approach the customer, where do you log in the details? Who will follow up? With what intervals? When do you stop following up? Etc. etc. So what are you trying to do is, when you establish SOPs, the chances of people deviating from those are less. And if you don't deviate, then the risk of an operational loss happening are lower. So all of these are mitigants. These are known as controls, basically. Mitigate means you reduce, right? Reduce the impact or reduce the likelihood, right? Transfer means you are completely getting rid of. So, for example, let's take, or let's say local one, right? If you take life insurance, right? What are you doing? You have basically said that the risk of you dying will have an impact on your family. In order to avoid that, the insurer will pay your family, right? Have you mitigated the chances of you dying? No. Right? You've not mitigated it. You've just transferred the risk of you dying in terms of monetary impact to the insurer. Mitigation in this case would be what you adopt a healthy lifestyle, right? You don't drink, you don't smoke, etc., etc., right? You take necessary precautions to ensure, let's say, you live long enough. So that is where you are trying to mitigate. Transfer is when you've taken insurance so that in case something goes wrong, it's the insurer who will pay the money. Okay. Does anyone know what risk appetite is? Sorry.
This seeking.
So that's risk behavior.
Willingness to observe.
Not willingness, I wouldn't say willingness. Risk taking capacity is what I would put it as, because everyone has a different risk appetite, right? Basically, let's say if I have a lot of money lying around, right, I can take more risk. As simple as that. Because I have a fallback. If I don't, then my risk taking capacity is limited. So risk appetite for an individual is influenced by factors like income, number of dependents, right? What your financial goals are, what your future, let's say your existing liabilities, your future liabilities, etc. For a company also, you can think of it in a similar manner. The capital kitna hai, right? One is capital availability, what the business plans are, what the business strategy is, right? All those factors will drive the risk appetite. What does a risk appetite do? It does nothing but set aside or tell you that you are okay to take risk up to this limit. Okay. The moment when I do such an evaluation and something like, let's say my risk appetite is somewhere here. Okay. So everything which lies beyond it is high risk for me. Now I will either accept or I will try to bring them on this side. Okay. By either mitigating or transferring. Right. So risk appetite is basically your capacity to take risk, which is determined by a host of factors. I think we just spoke about why different people have different risk appetites. So is risk always bad? There are positive risks, obviously, because if risk were everyone avoided risk, then there would be no growth, right? You would still end up, in terms of scientific innovations, inventions, everything, you would end up where you are, right? There would be no progress in society, right? So risk is obviously not everything is bad. It's just that it depends on your capacity to take risk, right? For example, Elon Musk today can invest in space flights and everything, right? Why? Because he has the financial funds as well as the standing in society to get the money he wants, right? Why does, let's say, Deepinder Goyal do all of these other businesses now, that aerospace, that temple chip, right? Nothing related to Zomato. Why? Because now he has the funds available to take such a risk, right? And those can lead to significant positive impacts in the future, right? So not all risk is bad. Risk can be taken as an opportunity as well. The opportunity is obviously when you put a price to the risk. For example, why do hedge funds speculate? Why do they, let's say, why do banks act on the opposite side of a derivative deal, right? For example, you're a company, you want to hedge your interest rate risk, right? You will do a derivative with a bank. Now, when the bank does the deal with you, bank is taking on the risk from you. Why are they able to do that? Because they are charging you something known as a commission. In very simple terms, so have you studied about derivative valuations or present values? Discounted cash flow वो सब तो बड़ा होगा, right? Swap में क्या होता है? You have in a swap, right? Let's say you have two legs, fixed and floating. A very simple floating to fixed swap, right? If I have to value this swap, right, where I am transferring floating and I will get fixed, right? How will I value it? For me, it is the present value of the fixed inflows less the present value of the floating inflows, right? So PV of fixed legs less the PV of floating legs, right? जब swap का pricing होता है, ये fixed जो set करना है. For example, I have a borrowing of SOFR plus 2%. Okay, SOFR is a floating rate which is used for derivative pricing. It's the US rate. Okay, SOFR plus 2%. I want to swap it to a fixed rate. Okay, so what will I do? I will go to the bank and I will tell the bank that you give me SOFR plus 2%, I will give you a fixed rate. So what essentially happens, I have to pay my lender SOFR plus 2%. So when the bank pays me, I will pass it on. In return, I have to pay the fixed rate of interest to the bank. Right? That's how a typical swap works. Ideally speaking, the fixed rate should be set such that present value of the fixed leg minus present value of the floating leg is 0. If it is to be equal to both parties, right, where no party is gaining, the PV of fixed less the PV of floating should be 0, right? Then I will solve for the equation to get the fixed rate. For example, this comes at, let's say, 8%. Okay? The bank will not sell it to you at 8%. Why? Because the bank is not selling to do charity, right? The bank is taking on risk which you don't want to take on. So the bank will offer it to you as, let's say, 8.25%. This 0.25% is what the bank makes. Now that is the price of this risk. Okay? This risk had a price. As long as you pay 8.25%, you can pass on this risk. Different risks have different prices. This one, because it's a very liquid market, the price is less. You talk about, let's say, have you heard of credit default swap? CDS is credit insurance. I take life insurance, which is insurance against the chances, or let's say insurance against dying. CDS is insurance for the chance that someone defaults. For example, if मेरे कोई bond है which is giving me 10% coupon, right? Now that borrower, let's say, has a chance of defaulting. If I want to get rid of that chance of defaulting occurring ever, right? What I can do is I can so in a CDS, what I will do is bond pays me 10% coupon. Okay. Now I have, let's say, whatever, I invested 100 rupees, right? What would the cash flows look like? 10%, let's say it's a 5-year bond, right? So time and your cash flow, time 1, 2, 3, 4, 5. I will get 10, 10, 10, 10 and 110. These are my cash flows. Now, what is the risk? The risk is that at any point of time, the issuer defaults. Right? So what will I do? I go to a person or a company which is willing to offer a CDS or a credit default swap. What happens is, let's say the CDS, let's say I am the investor, this is the issuer, and now you have the CDS party, the person selling you CDS. What you will do is the issuer is giving you 10%. You will pass on, let's say 1% to the person selling you the insurance. Okay. In return for what? Now, there are two possibilities. Either this issuer defaults or does not default. If the issuer does not default, there is nothing. Whatever you paid 1% for 5 years, that's gone. Right? But if the issuer defaults, right, what will happen is the CDS seller will pay you the entire 100 back or whatever is owed to you, right? So what are you protecting yourself against? The chance of default, because if this issuer defaults, this CDS seller will pay you the money. Okay. Now this 1% could be 0.5%, could be 4%, could be 5%, right? Depends on the issuer. So the higher the risk, the higher would be the cost of insurance. CDS spreads during the 2008-2009 financial crisis went up like crazy for a lot of companies. Why? Because the situation was such. So whoever was willing to sell insurance was willing to sell only at a very high cost. So buying insurance also became very expensive there. So there are CDS spreads traded in the market. So I don't think you guys would have seen a Reuters or a Bloomberg, right? But on a Reuters or a Bloomberg terminal, you can search for the company. वो company का आपको CDS spread दिखेगा. कि अगर 100 bips है, it means 1% is the cost of insurance. If it is 200 bips, it means 2% is the cost of insurance. Right? Okay, so yeah, I mean, how does this relate back to your actual control cycle? Your actual control cycle basically helps you identify what the risks are, what the solution is, which is the alternatives which you've considered for managing the risk, right? What are the costs associated with those? Do you have the capital for it or not? And then accordingly, you can take a call on whether you want to accept the risk or you will undertake some sort of measures to mitigate it, right? So how do you mitigate the risk? I mean, you say you avoid the risk, accept it, share the risk or transfer the risk. Sharing is reinsurance. Accepting and minimizing the risk is what I said, controls, SOPs, right? Small events, I will establish SOPs and documents to ensure that people don't deviate and there's no loss on account of those, right? Avoiding the risk is what I said as reject. So very high likelihood, very high impact, which can wipe me out. I will ideally reject the risk. Okay. And then transferring the risk, you can think of maybe as derivatives or where you take a full insurance. For example, like the cyber insurance here. So the risk from hacking or cyber security attacks, right? That is transferred to the insurer now. Okay, so now coming to the last part of this chapter, right, which is advice, right? So actuarial advice is basically you as an actuary, who do you advise, who your stakeholders are, right? Why is this important? Because advice can be of many types. I'll give you an example. Since I work as a consultant, right, we always mention in all the agreements we sign that we are not responsible for any decisions you make or any financial statements you make on the basis of models or inputs provided by us. Why? Because I'm saying my advice is recommendatory in nature. It is not binding on you. Any decision you make is your call, right? So there are different types of advice which are there, which an actually can advise on. Some can be indicative, some can be where you are actually going to be responsible for decision making, so on and so forth, right? But it's important you are clear on what those types of advice are, so that whenever you are working, you are clear on what the expectations from you are. Okay. Which are the types of clients that actuaries generally provide advice to? Who do actuaries advise? Okay, that's a class. Okay. But talk about broadly, let's say different kinds of companies also, right? Regulators in policy framing. Then,
Insurance company,
yeah, insurance companies, fund management companies, portfolio management, pension funds, pension fund sponsors, pension fund trustees, regulators, statutory auditors, banks, corporates also, where I mean wherever it's relevant, right? So it's a broad segment, to be fair. Majorly focused on BFSI, which is banking, financial services, and insurance. But yeah, I mean regulators, stat auditors. Why stat auditors? Because statutory auditors need to sign off on the financials. So every company has employee benefit valuations, which are always done by an actuarial firm. You can go home, pick up any listed annual company annual report, search for the word actuarial in that. You will find employee benefits valuation with that. Okay. And that is necessarily done by an actuarial firm, right? So technically you're advising all of them, right? Employee benefits. So there are obviously very many different types of clients which you can advise. Public sector is governments and regulatory bodies. Private sector is policyholders, benefit schemes, employers, employees, all insurance companies, stakeholders, trustees, sponsors, investment fund managers, capital projects, banks, everyone, right? Stakeholders that are affected by actuarial advice. I remember, I think, day before yesterday when we spoke, we did mention that when you are advising or when you work on any actuarial assignment, right, you generally need to consider the needs of all stakeholders. You cannot ignore the needs of one for the other. For example, you cannot really, or let's say where we spoke about conflict of interest, right? If I have a stake in a company, I should ideally not be advising them on the feasibility of an expansion plan. Why? Because if I'm already owning a stake, I want the expansion plan to take place so that I get dividends and returns, right? So conflict of interest. So you need to consider all your stakeholders who are involved in this process, right? So consider and actually giving advice to the board of directors that is planning expansion. When you're planning expansion, everyone is impacted, right? The first is employees only. Some might, have to be let go. Some might have to be retained. Some may get a jump saying that, expansion ho raha hai, to और लोग आएंगे, maybe increments and all होगा, right? So the employees are impacted. Board of directors are impacted. So, okay, tell me this, what's the difference between the role of a director versus the role of a promoter in a company?
Promoter does not have no decision making in terms of operations.
No, I own 70% of the company. I can make every decision I want.
On a daily basis.
That's why anyway, so director is not involved on a daily basis. Director is also not involved on a daily basis. Daily basis involvement is of the management, which is your C-suite and below.
Okay, right.
Promoter will have the voting rights. I mean, by sheer ownership, you have voting rights, right? Sorry? Directors are also stakeholders of the company. Both are stakeholders. Promoters are shareholders, directors may not be shareholders, but both are stakeholders.
It's like a widespread expansion plan. The promoter has the key sole authority, right? The director delegates. Is
The director will not have conflict of interest, while the promoter might have conflict of interest because he owns some kind of share with us.
Oh, maybe, maybe not. Yeah, that is possible, but then again, so the key difference, right, is the intention. Okay. See, in directors also you have classes of directors, independent and non-independent directors. Okay. Independent directors are the ones who are not involved with the company at all. Their job is to attend board meetings, monthly, quarterly, जो भी होता है, provide an outsider view on all projects or everything which is presented to the board for approval. Why will you do that? In order to maintain good corporate governance. मानो अगर मेरे पास independent director है नहीं, right? Can I say a promoter can be an all-powerful person? Board of directors में भी उसी को बिठाएगा जो हाँ बोलेंगे, right? So if I'm a promoter, I don't have independent directors. I own, let's say, 60% of the company, right? I will nominate people to the board who will be favorable to the projects I'm presenting or the projects which I want to pass. Independent directors are the voices who are expected to scrutinize as an independent person because they don't know what is happening in the company on a day-to-day basis anyway, right? So that's the key difference. If you have independent directors, it's a good corporate governance practice. It's actually mandatory for companies above a certain revenue threshold that you need to have a certain number of independent directors on your board to ensure that whatever decisions you are making are for the overall benefit of the company and not just to benefit the promoter. Okay, that's why you will see regulators don't allow promoter ownership beyond a certain percentage after a period of time. Very famous case, Kotak Mahindra Bank, where for banks you are not allowed to maintain ownership of more than 24% after I think 10 years or something, right? But Kotak was the one where they had a higher ownership. So they used to always get letters from RBI saying that when are you selling off your shares, right? Because you're not allowed to. Why is that? Because you don't want banks to be run by a corporate or by a single person. So that banks operate in the fairest manner possible, right? So you have limits also in certain sectors which are very important. So companies, policy holders, you will have shareholders because why पहले मुझे जो dividend मिलने वाला था अभी expansion के बाद मिलेगा नहीं मिलेगा, what is going to happen? It is possible if you are expanding, you may not be able to pay dividend for maybe a year or two, right? But is the trade-off fair considering that if the expansion works, I will get a greater appreciation on my share price, right? So shareholders, your policy holders, government also. Why? Because taxes expand karoge, then you will be spending. If you are spending, you will be paying taxes. which region are you expanding into, how are you expanding, all of that is where the government is concerned. Regulator is also separately concerned. Why? Because does the expansion impact your solvency? Does it impact it badly? Do you have the capital resources to fund this expansion or not? Then you have competition. Naturally, if you are expanding, other competitors or other insurance companies would be looking into what you are doing. It is possible they might also launch something which can impact your growth plans. So this is one case of a classic question which you end up getting a sub question in your exam, which is list the stakeholders who are impacted by the given scenario and explain how. A very standard kind of question which generally comes for 5 to 10 marks. Okay. So what you're again, if you see right, expansion is they spoke about everyone from policyholders, employees, directors, shareholders who are the owners. You have the government, tax authorities, your regulators, and everyone else, right? So again, focus on this because this is one of those areas where it's very easy to score marks. Because the number of stakeholders you can write down as many as you want till the time you're able to justify how they are impacted. Okay. An insurance company A is taking over another insurance company B. List the stakeholders affected by this scenario. In a takeover, how or who is impacted? Employees of company B, how?
Some of the employee benefits should be changed.
He can employee of company B because some of them may be let off. Because takeover हो रहा है सबको रखना may not be possible. Then of you have two companies. Both the companies, right? Because if you're acquiring shareholders of company A want to ensure that the price paid is fair and they're not overpaying for it. And company B वालों का उल्टा motive होगा. They get a good deal out of it. Because if you're acquiring or taking over a company, right, shareholders of company B will have to be giving either cash for their shares or shares in company A. So उस time में conversion ratio क्या मिल रहा है, that will be important. Then CFO. You can talk about management at a broad level. So because CFO, CRO, let's say appointed actually bhi hoga. I mean, for an combined entity, you will always have a single one, right? So that's when employees of company B, usme cover ho gaya. They might be worried, or even for company A, right? Because it is possible for some you might retain the company B employees.
Because competition should not.
Yes. So the government would be, regulator will be concerned about competition. Regulator will be concerned about the combined solvency. Government will be concerned about tax implications of company. A is buying, B is the seller. B, buy.
The policy can be different from the country. They might alter it according to their.
Okay, yeah. So one is benefit structure might be altered. Second is they want certainty of the benefits, right? At the end of the day, whether B pays or A pays, they don't really care. But they want continuity and consistency of benefits. Even policyholders of company A, because if you are acquiring, you want to ensure that your solvency position is not impacted. See, policyholders care about solvency because that's where the money for them comes from, right? So they don't want the reserves to be depleted.
Intelligent assets.
Which one?
Intelligence related assets. Like AP must have been using a particular third party app. And A would be using it for like claims or whatever.
But that's not a stakeholder, that's an operational factor. For example, मेरे पास एक A has its own tax, which is policy admin database system. B has its own policy admin system. When both one takes over the other, right, you will not maintain two systems. Why will you pay double the license fees and all? You will retain only one, right? So in that case, okay, so then you should, okay, then the parties impacted are vendors. You can say vendors, yeah. Vendors, because now you are worried ki whether your system will be kept or not, whose services will be retained, right? So yeah, vendors is the valid one.
Both vendors, like insurers or creditors.
Vendors and anyone, yeah. The insurers also will be impacted here. The insurers you can mention as a separate stakeholder.
The assets of the company, like which branch would be taken, which head office would be.
But then that impacts employees majorly, right? Which is already covered. Vendors is not covered, so vendors is a good point because you have systems, you have two different organizations, right? Serviced by so many different vendors, right? For example, let's say if I'm advising an NBFC, right, which gets taken over, if I've been working with them for 3 years, right, I will be worried कि जिसने take over किया वो मेरे services को लेगा या नहीं लेगा. So that's the point where services as well as systems, the vendors would be concerned that what will happen to their services. Customers are policyholders. So banks, yes. Creditors and banks, you can either mention them separately or together. Creditors, naturally, because one is being taken over. So generally, when creditors give or lend money, right, they stipulate certain covenants. Covenants का मतलब क्या होता है? Limit डालते हैं. For example, they say that you cannot raise money again without our prior permission. They can also say your debt equity ratio cannot cross X%. If it does, you are breaching our covenant and you will not be allowed to raise, right? So whether your covenants are being breached or not, that will also matter to the creditors. Banks, how they may be funding the takeover. Just one, yeah. They may be funding the takeover. So A is acquiring B, हो सकता है A के पास वाला पैसा सब लाने के लिए, it is possible they would have borrowed money from a bank or a bank would have funded the takeover, right? So banks would be interested in, if it's a good opportunity, banks would want to. If not, then they will evaluate it.
Or no, you were explaining that policy holders also will get affected.
Yeah.
But if like recently, like IndusInd bought Reliance.
Okay. IndusInd
like bought the stake and
it's कौन सा नाम से जो Reliance Nippon became IndusInd Cent Insurance, right? Okay.
So but if suppose the policy was given by Reliance, whatever was the intricacies of that policy must be honored, right? If suppose
I guess it should be.
so, but how does that affect the policy holder? By if suppose
It depends on the person taking over, right? For example, let's say a Reliance, right? Reliance had a stake in this JV joint venture, right? Reliance is now substituted by IndusInd, for example, right? Now, depending on the relative credit worthiness and the strength of the two parties, policyholders may or may not be concerned. For example, ideally, because they're heavily regulated, honestly, they should not be concerned, whoever the end owner is. However, it in theory will act on their concerns because if I have very deep pockets, right, then you feel safer. Saying that even if the reserves go down, your parent will fund any shortfall which is there by putting in money, right? So that is how policyholders would be concerned. And the other factors would be, name left, right? Solvency. For example, A operates aggressively. It is obviously above the regulatory minimum of solvency, but close to it. However, B was much more conservative and operated prudently. So now B's policyholders might be concerned that okay, A is much more aggressive. One event might impact their solvency much more, which can impact the payments I expect to receive on my funds.
Shareholders.
Sorry?
Shareholders.
Yeah, shareholders of both.
Investors, outside investors, it could be speculating on this branding, share pricing stuff.
Investors, yeah, you can say that. And even they can be impacted. Competitors, yes. Competitors will be impacted because if the competition is being consolidated, right, it is possible a bigger entity will have more power to go more aggressive, right? So competitors will also be watching it to see if there is consolidation happening, how they can change or tweak their businesses to ensure that they still remain relevant. I think someone mentioned, regulators will be very directly concerned here because of competition, solvency, whether not the merger, but the acquisition is good for the industry or not, right? So you need their green signal anyway. In reality, any merger acquisition in the BFSI space, right, cannot happen without RBI or IRDA giving their approval. Okay. A layer further, government में CCI का approval लगता है. CCI is the Competition Commission of India. So in any sector, right, any merger or acquisition can go to a fairly large merger or acquisition cannot happen without CCI giving its approval. So you have two levels of approval anyway before before a merger or an acquisition goes through.
So when I'm trying to acquire some company, I have to take two approvals. Wouldn't the news leak and then like
ये वो पूरी domain नहीं होगा.
they would use more better defense strategies. They'll have time.
It can happen. You have hostile takeovers also, right? Hostile takeovers can also happen, but you have to disclose this to the public domain. I think the most recent one was the Netflix one, right? Who was acquiring Warner? Yeah, so that one was the most recent one where Paramount, Warner, and Netflix, right? So Netflix was acquiring in a proper manner, and then Paramount, I think, mounted a hostile takeover bid, saying we will offer you $2 more to the share, right? And that can always happen because see, how it works is you get one proposal for acquisition, you put it up to the board, you put it up to the shareholders. If they approve, you go through. But in the meanwhile, if you get another proposal, right, it's your duty to put it up again to the shareholders because if it's the better deal, you need to ensure that you're providing the best deal, right? So ये सब हो सकता है, which is fair. I mean, but it has to be in the public domain then. Someone said. List the potential areas of advice of each, but I think we spoke about it, right? Again, how do actuaries advise for, let's say, the list of stakeholders, right? Where can actuaries advise government in?
Policy making.
Policy making. Yeah, policy making. Also, you have the Indian Statistical Service (ISS). A lot of the data analytics and gathering data on economics and framing policies there is where you can advise them. Central banks and regulatory bodies. So let's say RBI or IRDA, again policy framing. You can also be a part of their what do you say, overall department of supervision also, saying you will monitor the performance of different insurers or banks and collate those in order to obviously frame policies and direct best practices in those companies. Right? Policy holders. Pensions
Is the right coverage for them.
Yeah. Actuaries can advise on the right coverage for them. Which product is more suitable for them. Again, don't think of it as an actuary employed in the company. Any actuary can basically, if you're operating independently as well, right, you can basically provide advice, saying which is the most suitable product, considering your circumstances, your risk appetite, etc. Members of benefit schemes and their dependents. Everyone knows what benefit schemes are, right? Pension schemes. Defined benefit, defined contribution. Members of benefit schemes. Yeah, whether the returns being provided, whether the investment returns which are there are, let's say, sufficient or not. And the other part is when you're reaching maturity, right? Which product should you transfer it into? Whether you should buy an annuity, whether you should do partial lump sum withdrawal and partial annuity. That is one area in which you can advise them on. Employers and employees, again, this is highly specific to the scenario. अगर मानो takeover या कुछ हो रहा है, takeover or merger, right? For employees, what will you advise them on? In a takeover or a merger.
loyalist.
Yeah. So that's a good point because contribution जो हो रहा है to your pension schemes, right? Whether that is correct or whether that is sufficient or not, right? In a post-merger, pre-merger, or whatever situation there is. And the second is the benefits being offered, right? Whether they are in line and commensurate with the benefits being offered elsewhere. So generally, all this is actually a practice, I think, in Mercer or WTW, right? Where you have a benefit and reward study, which they typically carry out. So they approach all insurers, all consulting companies, everyone, and ask what their actual study scheme is, what their rewards are. For example, you're going to be कितना पैसा देते हो, increment क्या है, क्या levels हैं, right? So that sort of an insight can be provided based on your experience. Yeah. Board of directors, shareholders, creditors, auditors, we've spoken about. Auditors, yes, because auditors are not experts in actual valuations. So insurance may anyway, the valuation you do of your liabilities, a statutory auditor is not qualified enough to validate that, right? Because those are some complex models. So actuaries advise them there. Creditors for whether the covenants set up are appropriate or not, whether the cash flow of the company is sufficient to meet the rate of interest you are being offered or not. Should you be offered a higher coupon or a lower coupon, etc. Investment fund managers is self-explanatory or investment strategy. Members of investment schemes is also similar, what their investment strategy and goals should be. Banks also, there are a host of areas, capital adequacy, credit risk modeling, asset liability management, derivative valuations, hedging strategies, how should you set up your treasury book, right? A whole host of different areas are there in banks where actuaries can advise in. Sponsors of capital projects. What are capital projects? What are capital projects?
Every investors,
Invest?
investors.
No, not investment trust.
Investment banks. Or specific.
But what are capital projects? Okay, sponsors of capital.
Yes. Yes. Raising of funds.
No,
High cash involved.
high investment projects, right?
There may be a future cash flows.
Yeah, I mean, whether future or immediate, that depends, but capital projects are typically associated with infra investments. मतलब बिल्डिंग बनानी है, रोड बनाना है, रेलवे ब्रिज बनाना है, right? So when capital projects are basically bigger ticket investments, which will have a longer gestation period. Okay. So why are you advising them? Sponsors, मतलब the ones who are funding those, right? You will advise them कि IRR जो दिख रहा है, cash flows जो दिख रहे हैं, NPV जो दिख रहा है, right? Based on projected cash flows. So you assist them in projecting cash flows, building models based on assumptions कि क्या inflow आएगा. Is it meeting your hurdle rate threshold or not? Right? Is it meeting your NPV or discounted payback period thresholds or not? So that's the area on which you can advise them on. See, how you advise them again, this is something which is, yeah. Yeah, I mean, which one to choose? You mean to employ provident fund or whether you should opt for it or not? Because I mean, EPF में advice जैसा कुछ है नहीं, either you opt for it or you don't opt for it. Because so for example, when I was working, I had not opted for EPF, right? But I think most people opt for an EPF. So the choice there is whether you should opt for an EPF or not. That is an area, yes, you can be advised on. The other area would be the India where you have pension schemes, okay, which you can invest in. So NPS के pension schemes होते हैं. tier E funds होता है, tier A funds होता है, tier C funds होता है, right? And those are offered by many companies. So LIC, UTI, Aditya Birla, Axis, you have like all of these pension scheme managers, right? So you can advise them on the कौन से pension scheme, pension fund, like fund management house के कौन से pension scheme में you should invest. That can be one area. But EPF is a yes or no. I mean, because once you elect for EPF, you don't have control over what do you say, the investment returns, because वो तो government declare करता है every year around February March. So how do you advise? Let's say before you advise, right? What do you need? This is again pretty generic. If I have to advise anyone, right? I need data. I need information, right? You come to me and say that I have 5 lakh rupees. I want to invest. Oh, based on only that information, I cannot advise you. If I do, that means I am not a good advisor, right? Because 5 lakh rupees here, okay, objectively I understood, but 5 lakh is a percentage of your net worth, how much is that? If you're worth 5 crores, then okay, you don't really care about 5 lakhs, right? But 5 lakhs you have when your net worth is 10 lakhs, right? Very big amount, right? So all of this information, which is what is your income, your future, your plans, your goals, your current income, your current loans, right? What is available in the market? The कौन से products है 5 लाख रुपए किसमें invest कर सकता हूँ, right? What is the universe available? What is your tax bracket? Are you currently paying any tax or not? Because if you're paying tax, then ideally I want to ensure you have a lower tax outgo on account of income from those investments, right? So many factors which I need to consider, which I will get once I talk to you, right? So you need to gather information before you form any opinion or any advice, and you advise on that, right? So the most important part is to gather the information, right? Which is relevant, obviously. Here, in our case, would be relevant to your circumstances as well as overall market. Overall market data, तो चलो मैं निकाल लूंगा. But circumstances relevant to you or specific to you can only come once we sit down, we have a chat, and we understand, right? Think of it as any project you do for those who are worked, right? Any problem given to you, you cannot start working immediately, right? You need the facts surrounding the case, what your objective is, कौन से system से data आएगा, what systems I have, what programming capabilities I have, right? So you cannot start on something immediately, or you cannot give a solution without knowing all the facts surrounding the case, right? Any subjective information should also be known. So when you're deciding investments or advising someone on their investment plan, right? This is where a lot of subjectivity also comes in, because every person will have a different risk appetite. So maybe you are very happy to take on risk, but someone with the same level of income, same investable funds, does not want to take on risk, right? So now that can stem due to many reasons, but those facts need to be known, because they will also influence the way and the final advice you are going to give to your client. Frequent follow-up meetings, again, all pretty generic. There is nothing new out here. You gather information, gather any quantitative or qualitative information, develop an initial advice, keep revamping it, keep modifying it based on any new facts which come to light and based on any new information which is provided to you. You are an actuary at ACE Consultancies, which has been approached by an insurance company planning to venture into crypto. Suggest all the information you will require about the insurance company to provide them with the advice in the best of their interest. You want to invest, an insurance company wants to invest in crypto. You need to advise them on that. What information do you need? Correct? Market cap. Market cap is honestly determined by if it's a listed company, right? You don't know that.
What are the products they sell? What are the products they sell? Because technically, like,
Yeah.
based on that, what kind of liquidity or
Yeah, so first part is what products do they sell, right? Uske basis pe, what is their current investment mix also? What is their liquidity requirement, right? Because if you suggest some crypto which is not very liquid, right, it will not serve their purpose if liquidity is important for them. Or else
The country,
risk appetite, right? Unka risk appetite kya hai? Does the risk appetite allow it or not? That will matter.
the country they want to invest.
So in the country they want
Because each country has its own crypto regulations. So
crypto regulations, they need to be fair. I mean, very little,
but
right?
India there is
You have the digital rupee, उसपे limited regulation है, right? But ठीक है, I mean regulation. Let's call it not the country but the regulation, right? You would want to know what are the regulations surrounding crypto.
basically what you suggest to maintain accommodate or
Correct. So you need to see again. You need to know the 360-degree information about that company, what their products are, what their current solvency is, what their risk appetite is, what their liquidity requirements are, what their taxation rules around crypto also are, right? The legal status of it. Once you know all of this, will you be able to provide some sort of advice, right? Again, so if you ever get such a question, right, think about basically put yourself in those shoes, right? Then you will be able to think, okay, if I need to advise someone, what do I need to know? We've spoken about conflict of interest a lot, right? Conflict of interest can arise due to multiple reasons. You also have something known as Chinese walls in companies. So Chinese, okay, so a very relevant case would be Big Four. तो सबने सुना होगा. Big Four does audit as well as advisory. Can a Big Four firm advise the same company it audits? No. Why? Because it's a conflict of interest. I'm giving advice to someone whose books I will be auditing. That's a conflict of interest, right? Because if my advice was faulty, I will not bring it up in my audit, right? So, but a Big Four does both, right? So what they have is separate teams who will not interact with each other. So that is known as Chinese walls. Though they are a part of the same employer, Chinese walls basically means barrier in the sense that they will not share information or communicate with each other because they have separate mandates, right? So conflict of interest, as I said, that one was the most common example. You cannot advise a client whose books you are auditing, and many others which we've spoken about so far, right? So how do you avoid it? One is to you yourself say कि भाई ये यहाँ पे conflict of interest है. Remember the example I gave you of judges who recuse themselves. It's a very frequent thing. A lot of times you will come across articles where judges recuse themselves from certain cases. Why? Because there is a conflict of interest. If the victim or the accused are in some way connected to the judge, right, then they recuse themselves because they don't want any conflict of interest to prevail. Okay. Chinese walls, complete independence of work. Again, Chinese walls, and I mean they mean the same. Data must be secured and kept away. So काफी टाइम ये भी होता है कि at least for the ones who worked, right, you all would see that access to certain kinds of data are available only with certain people or certain departments. It's not available for everyone in the company. Why do you do that? Because you don't want, so you basically show someone only what they need to be shown. You don't need to show or expose everything to everyone, right? So that is why you have all these data controls and admin systems which are there. And getting the balance right, this is the thing though, because people have conflicting objectives. The example we spoke about, new insurance product being launched. The sales team wants it to be priced as cheaply as possible. The actual team will not be able to do that. Why? Because jitna product loss making ho jayega, for example, beyond a certain level. So you try to balance the conflict of interest between these two. I mean, their interests are different. Your sales team का पैसा आएगा जितना बेचोगे उससे. Actual team has no incentive linked to the sales, at least not direct funds, right? So these are the types of advice. You have indicative advice, which is it's basically an opinion. मतलब कोई मेरे पास आया किसी ने पूछा and I just advise them, right? I just give them an opinion. Maybe I'm not charging them any money or anything, right? It's just out of service which I'm doing it, right? So someone asks you a question, you advise them. You're not. It's not binding on you that you have advised them. So they cannot hold you to that word because they came to you with a question, you just answered it. It's just an opinion. It's not even a formed opinion or a firm opinion because you don't even know all facts relevant to the question. So that's an indicative advice. Factual advice is a step further, where you put in the effort, you gathered information, did your own research, and then came up with a detailed opinion saying this is your problem statement, this is the solution. Okay. Recommendation is the third step, which is where you go a step. So the example I gave you, right, where I say that any use of what I give to you is at your discretion, right? Because what I'm giving you is based on whatever facts you provide. After that, if I give them certain recommendations which they adopt, then it is recommended. So any validation or review exercises which are done of actual models or anything, right? You generally have all the shortcomings identified and recommendations given to rectify the shortcomings, right? So how do you come up with those? You do your own detailed exercise, your detailed models which are there. So that's the last step, or let's say the most advanced type of advice. First one is not binding, it's just a verbal advice. The second one is where you've done your research and then given an opinion. Third is you've gone a step further and even given recommendations, which your client may or may not implement.
So, sir, can we say that basically you talk about actual advice? It basically consists of for adequate coverage of insurance policies and risk stuff. And if we talk about recommendations like broad consultancy and advisory stuff.
So one could be okay. So if we take the same example, right? Let's say you come to me for advice on term insurance cover, for example, right? One is the first level would be you ask me, Neil, where can I, what should the cover I want? What should be the cover which I buy, etc. Right? And very simply, I say, your age is so and so. This is your income. I think ye cover acha rahega, right? That is the opinion which I'm giving you. The first one, indicator. Second is you give me your facts saying this is my income, this is my age, right? I go a step further. I go online, I through various channels, I look up products for you, right? And I send you the details. Saying ye dekho, ye 5 companies hai, ye 5 covers hai, which may you can choose which one you believe is the best for you. Third step is I gather all the information. मैंने 5 product निकाले, 5 cover निकाले, उसके cost nikala, right? And then I did a detailed analysis and I found out that, based on claim settlement ratios, companies, reputation and all, I think this one is the best one. So where I tell you this is the one you should ideally buy, that is recommendations. Till the time I don't recommend, I am just gathering information and giving to you, right? Saying these are all the policies available, you can choose out of those, then it is factual advice. Okay. And I think you all know what peer review is, right? What your colleague does, you review. Important, it is quite important because you may make mistakes because we are human. So a peer review ensures that if there are any mistakes made, they are rectified before you give your final opinion or advice. So this is the area which is where you are advising but not deciding. This is typically what all consultants do. They advise but they don't decide. They recommend but they will not decide on behalf of you. Right? So what becomes very important is, so आपने कभी report देखा नहीं होगा, but generally any consulting report which is there, right, उसमें एक बड़ा होता है disclaimer page. Disclaimer and notices होता है, मर की right, what their assumptions are, what they've done, what they've not done, right? So all of those basically clearly point out that we've prepared this on the basis of the information you provided to us. We've not taken let's say we've not taken the steps to verify whether the information you provided is correct or not. These are the assumptions we've used in the model which we've discussed with you, right? And based on that, we've arrived at the final report, right? So assumptions which you are using, why you've used those assumptions, telling them that you could have used three other assumptions, but why you are not using them. So whatever final advice you give them, which is recommendatory, but you are not deciding on their behalf, right? Think of it that you are the client right now. If I tell you that I've done all of this for you, right? I also need to tell you what I've not done and why I have not done that. So that at the end, you are the one who is making the decision. You need to be sure, or let's say you need to be aware of what are the possibilities and why one was discarded in the favor of the other, right? So all of these factors basically need to go into the report or the model which you are preparing and delivering as your final output. So this is where you are making decisions, right? An example they've given is in the determination of surrender values under LI policies, right? So where you are making the decision is ideally as an appointed actually, because you are employed with the company and you are responsible for finally signing off on all the embedded value calculations, product pricing calculations, reserve calculations, right? You are within an executive role and the regulator also relies on you. Because the appointed actuary is not just answerable to the company, the appointed actuary is answerable to the regulator also, right? So all the decisions which you are making, you need to ensure that they are well informed, they are justified, they are within the regulatory constraints or the rules which are there. And this is where you also have all the reviews and validations done. For example, EV calculations of the embedded value, you get it validated by an external party. So WTW, Milliman, all of these guys, EY, they come and validate and review it. Embedded value is basically a metric which is used to track insurance companies. The embedded value of the business kya hai. Exact details I also don't know. Because again, I'll be clear and upfront, I work on the banking side. Insurance side, I don't really work on, right? But you can look it up. From what I understand, it's a metric used to identify the intrinsic value of a company. उसमें काफी assumptions जाते हैं, तो you need to get it validated. Actual report भी जो होता है वो validate होता है by an external party. What is the purpose? So even regulators in their guidelines, a lot of the times they mention that this function or these details need to be externally validated or reviewed once a year or once in 2 years. The objective is to ensure that if internal people are missing out on something, a set of fresh eyes can identify it and ensure that you are properly compliant with the regulations. This is where remember I said you have something known as the actuary's code. Actuary's code में ये 6 चीजें हैं: integrity, competence and care, impartiality, compliance, speaking up and communication. Okay, all of these are self-explanatory. Professionalism and ethics, whatever you can think of, no conflict of interest. If you identify something is going wrong, speak up, bring it out, right? Communicate your results clearly. Comply with all regulations and guidelines which are there. So this is a part of the actuary's code. You can search for it online. It's a 2 or 3 page document. Open source, available on the IFOI website. So actuary's code होता है और India has, I think, TAS or APS. I'm not too sure. You have something known as actuarial practice standards and technical actuarial standards, TAS. So they guide different areas of work. So LI के लिए अलग होगा, मतलब different areas के लिए they give out broad guidelines of how you need to ensure professionalism is maintained. Okay. Again, you don't really need to know the contents of your APS or TAS, right? Neither do you really need to know the contents of the actuary's code, but you need to be aware of what professionalism entails so that you are able to provide advice in a fair manner. See, TAS. So TAS is published by the Financial Reporting Council. Yeah, they do talk about transparency of assumptions, completeness, reliance, etc. Right? I will not get into the details of this. You can go through this at your leisure. Search for it online. You will find a lot of material, right? Not directly examinable also. You will ideally be liable for all this once you start working because you'll have to comply with these standards. Okay, yeah, I think that's the end of our chapter, right? Anyone have any questions or anything they want to share or any feedback on if you want it to be conducted in a slightly different manner? Happy to do that. You have 18 chapters. So, and I believe this term is fairly long as well. So completing the syllabus won't be a challenge. So, but what matters is you guys need to practice. So I suggest one thing, once you complete one unit, right? I think one unit has 4 or 5 chapters. You go through it, you don't really need to learn everything, but start going through the practice questions of that unit, right? Start writing it down or in whatever way suits you, right? Because then once you complete unit 2, we will, before starting unit 3, we will discuss unit 1 for practice questions. So we maintain that one lag so that you have sufficient time to go through before we discuss. And discussing it is very important, the practice question, because I'm telling you, if we go through this in this manner, you will find the exam questions challenging only. The only way you can attempt the exam questions well is by practicing. Because only then will you get an idea of what sort of questions generally come up. So that's why ensure don't fall behind on the PQ. Whether you write it or not, I leave it up to you, honestly. Whatever works for you. But ensure you at least go through the questions properly, go through the solutions as well. Okay? Okay. I'll just take attendance. Anna? Anna is not there. Krish? Ria? Ananda? Aswin? Durga? Alan? Advait? Anuja? Arvind Takshan? Nikhil? Nikhil is not there. Prapti? Rashi? Gauri? Adit? Pranav? Roshni? Shraddha? Ashrita? Navya? Alina? Anmay? Pratham? Ranjan? Kaustubh? Isha? Iris? Neha? Yash? Ashla? Srishti? Aditi? Kavya? Maya? Vedant? Alan? Aditya? Chinmay? Anshika? Nitin? Riva? Manav? Vansh? Deepak? Rajdeep? Abhinav? Ishwar? Arya, Harshaya, Mansi, and Divija, which she was there.